you're seeing currencies devalued, across the globe, and that's something that's going to continue. The rise in things like gold or Bitcoin are telling you that the currencies as a whole are getting devalued.
This is Dunnigan Kaiser, founder of Liberty in Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us, kaiser@milesfranklin.com.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. You're watching a Liberty in Finance interview, and with us today is Bill Baruch, the president of Blue Line Futures. Bill, thank you so much for joining us today.
Thanks for having me on. Really glad to join you.
Definitely. Now, I'd like to get an update on the precious metal markets. What is happening with gold and silver right now?
Well, first I want to say I love the fact that we've seen the tape just reinvigorated. There's new life in this market from where it was at the end of March, and that's selling as we saw Treasury yields just really melt higher. You're seeing currencies devalued, across the globe, and that's something that's going to continue. It may not be the U.S. dollar that's always going down, because you have to think about it. When you see the U.S. dollar, you're looking at it as a pair against something else. Even the dollar index is a basket of currencies, with 57% being the euro. So it's always something that's being paired against something else. The rise in things like gold or Bitcoin are telling you that the currencies as a whole are getting devalued.
And mentioning that, kind of getting into the fall in the dollar we've seen really since the beginning of April, we've seen the dollar fall, and also Treasury yields have really been flat since the beginning of April. Your perspective on that and how that is having impact on the precious metal markets?
Yeah, I think the slow moving Treasury yields at this point, digesting that really melt up from 1.25% to nearly 2%, was fast. That the velocity of that type of move really sends ripples through markets as a whole, and that's something that we feared. Pointing back to turning into the autumn of last year, we were looking for yields to rise, inflation to show up. Inflation, not through the Fed's metrics, of course, but the metrics that our pockets feel inflation has shown up. So that was something that we looked at as playing a big role over the first quarter. And the melt up, you see a dynamic shift in the market itself. You get these melting moves, and that's what the Treasury market has done. Now it's digesting that. I don't think the high in the yields are done, but I think what matters most is the velocity of that. Is some of the highest velocity is I think out of the way, and that alone can help bring support to gold. So even if Treasuries are moving, the yields moving up a little bit, or the prices are moving down a little bit slowly, I think gold can capitalize off that. Silver can still capitalize, if the other parts of the sort of the stew out there are working, which would be currency weakness. So that's really how I'm looking at things as we head into the summer and what people may be talking about as the taper from Fed policy.
And how will the talk of rates really impact the markets going forward? We saw a little bit of that yesterday when there was a bit of confusion, I guess, with what Yellen was talking about regarding rates, how that actually did move the markets down and then back up today.
Yeah, well, it shows how vulnerable the market can be to the rate story and potential taper. The taper is going to come, but they've done a really good job, the Fed in general. Of course, Yellen's the Treasury Secretary, and she doesn't make monetary policy. But the Fed has done a really good job in really saying that they're not thinking about tapering. Because if they were thinking about tapering right now, markets would start pricing that taper in. So what they do, and I remember writing a lot about this going back into 2013 when Yellen was heading the Fed. They would come out with maybe whatever they wanted the policy to be, very dovish minutes, and then the committee members would go speak less dovishly or even hawkishly and sort of test the market's resolve. And that's something I think we're starting to see now. I don't think it was much of a slip by Yellen. I think it was something that more or less planned. And then you have Fed President from Dallas, Kaplan, talking about the taper discussion needs to start happening. He's the known hawk, but he's not a voter until 2023. So if they're going to start just sort of probing the market's resolve, this is a great way to do it. Cleveland Fed President Mester, more on the hawkish side of the scale, and so is Boston Fed President Rosengren, talking here on Wednesday, saying that inflation is going to rise. Nothing really too hawkish, but this is where you start to pay attention. They're 2022 voters. Start to pay attention to the committee members probing the market. I mean, these are very smart people, and I think the Fed has done a terrific job. They are very coordinated in their actions, and what you're going to start to see in the coming months into July, leading into Jackson Hole, is start to see them talking, different white papers talking about the policy in general, and then you could start to hear something in Jackson Hole about a taper, and then the September meeting firming that up. So that's really what you got to look out towards. And if they do a really good job, then you'll just see the 10-year yield maybe rise from 1.7 slowly to 1.9. In a 2% ceiling. If they do that do a really good job in that stays contained. Markets in general can, you're not going to see a taper tantrum, in equities. You're not going to see the fallout in gold and silver similar to we saw in February. So I do trust for now that we're going to see them do a really good job, and they've started to probing the market.
Do you think this is healthy for the markets, though, when we have this situation now where we don't really have a correction in the stock market? I mean, we saw a big crash at the beginning when COVID hit and everything like that. But really, besides that, we haven't had market corrections, right? Is that really healthy for the market?
We haven't seen the correction really much at all. 2%, 3%, 5% different swings. It's definitely very interesting here. I've been cautious, and I put out research each day. 4186. I'm not somebody that's out there as a doom and gloomer, and I'm a wealth advisor too, and I trade futures. I do a lot. I have a commodity fund, but as somebody who is long equities, I was extremely bullish as we chopped around through March, and we really had a breakout. So February chop, March was really where it broke out. April was the defining breakout. So that was a move that we were calling, and 4186 was our target in the S&P for that breakout. So as the market approached there, it really felt exhausted, happened extremely quick. So I've actually turned slightly bearish in the near term here on a trading basis. And these corrections, which were pullback yesterday, very healthy. Any type of pullback, very healthy. I would love to see a move back down to 4,000 in the S&P. And what I'm doing is, you've got to prepare by hedging some of your exposure. So on the advisor side, we are long some puts in the S&P in order to protect some downside, different put structures. So we're not just out there paying for vol and paying for time premium that's just going to decay if the market doesn't roll over. And then you continually trim, or you continually rotate within different sectors. I mean, we're getting very creative with things that we're looking for in the market. So there's going to be choppiness. There's going to be ways to protect yourself. There's ways to rotate. And there's, you want to have alternative investments. Within our portfolios, we have a 10 to 15% pocket of real asset exposure. Within that, you have midstream energies, energy trend higher in inflation. You have REITs, rising rates. REITs perform well. We have metals. Gold may not perform well with the rising rate, but you're going to see platinum, palladium, other metals do well. So we have exposure within that and being diversified. But at the end of the day, the higher it goes, the greater it could fall. So that's why you do want to hedge yourself and be protected. But you're not going to make money, being too worried about it. I mean, or being a bear, being a perma bear, if you will.
So what I'm hearing you say, though, is that you are slightly bearish in the short term, but you don't see a huge correction. And long term, even if the Fed tapers, you're still bullish.
Yeah, if even the Fed tapers their exposure to their bond purchases, I think that we get a nice correction that would prove to be a tremendous buying opportunity. At the end of the day, some of the melt ups in the market where without this extra policy, the loose policy measures, they may be a little more contained. But I don't think it stops a bull market. But it doesn't mean that the S&P may not perform, and the Nasdaq may not perform over the next 2 or 3 years after they start tapering. But there's going to be stocks, individual stocks, sectors that do terrific. I mean, I think crude oil can get to $100. I mean, what do you think the energy stocks are going to do if crude oil is at 100? The energy space within the S&P is only a 9% sector, roughly, give or take where it is. But considering that, there's going to be sectors that perform. It may not be what you see the headline, the S&P or the Nasdaq do.
Now, I have talked to people who are very concerned about the stock market. And one of the things they point to is the PE ratio, especially the cyclically adjusted PE ratio. Your perspective on that, because some people say, it's completely out of whack. It's in a bubble right now.
And that's true. I mean, there are expensive corners of the market, expensive pockets of the market, obviously tech being one. And that's one of the reasons why we're digging through some small and mid-cap stocks to really try and create a basket within our portfolio that of stocks that we don't feel that are too expensive at these levels, even though they may have doubled or tripled from their pandemic lows. And again, that's the part of being creative. That's the part of understanding the market and not being a perma bear. So you get a nice consolidation through February and March, and it's going to break one way. We break out to the upside. You have to be long, or you're going to be underperform. And once we make that move, you know your levels to that upside. And then once those levels have achieved, you're either trimming some of those gains or you're buying protection. So it's a continually a game that management, active management is the way to do it. But of course, you can't ignore some of the exorbitant PE ratios and how expensive a lot of the corners, not a lot, but some of the corners of the market are.
No, when it comes to kind of the short term, as we're looking at the markets this week, we have on Friday the non-farm payroll numbers. How do you think that will impact the markets?
I think we had a Fed message that was very, very dovish last week. And as I said, you're going to start seeing the committee members probe the market. But I think the message last week is also coupled with what we have as a non-farm payroll number. You got nearly 1 million expected jobs added in April. And we had nearly 1 million for the March report. We're still 8 million jobs short after that March report to recover the pandemic. Now, all things considered, from the great financial crisis, we were still never fully recovered all those jobs. But let's just focus on the COVID jobs for now, 8 million short. We're going into summer hiring, reopening hiring. There's going to be jobs created at least over the next 4 months, close to 1 million. If we stay on that pace, we're still 4 million jobs short. That's one of the reasons that to imagine that the Fed is going to stay dovish and not rush to taper. But if we start seeing those 1 million jobs, the market is going to react a little bit, knowing that the Fed, it's going to push their taper forward. It could be in the second half of this year, not necessarily in 2022. So if you get more than 1 million jobs created and this number on Friday, it's definitely something that I think that the market may not react so enthusiastically about. We've seen really good job reports surge the market higher, but I think that could be something that's going to change. You did see today the ADP, and definitely listen. You got to take ADP payrolls with a grain of salt. It's a private survey, but we had a little bit less than expected, and the algo stepped in. A big, nice little quick 4-point pop in the S&P. You could see what the market itself, how it was going to react if that number comes in light.
So what I'm hearing is that it's probably going to be a positive number this Friday.
I wouldn't be surprised to see it over 1 million jobs, but right around 900 to 1 million is really what the market is ready for, even if it's just a little above a million. But I think that the million, I think the official expectations are 980 or so, but the million is going to be that number. You start getting above 1 million job creation, it's going to get the dollar going, it's going to get rates going higher, it's going to suppress gold and silver, and the stock market is going to gyrate a little bit lower in a healthy pullback.
So with respect to the precious metals, if we do see, better than expected or still a pretty positive job number, you see that putting a little pressure on the metals for the short term?
I do. I think the dollar responds the way I'd imagine it would pressure the metals. If the rates respond to a number like that, the way I'd imagine it's going to put pressure on the metals. So that's something. We are long gold and silver. Like I mentioned, that real assets pocket of our portfolio and the wealth side. We have exposure there. In the future side, I'm trading. As we moved into 1800, I've remained long. I've trimmed some of this from the March lows, but I've remained long gold and silver and hedging some of my deltas with gold puts going into Friday. So I think that you just got to be actively managing it, just the same way if you're trading futures and you're trading gold, the same way I'm talking about rotating within sectors on the equity side.
Definitely. I think that's the distinction between trading and holding for the long term, right? When trading, you have to look at all of these price movements and all of the technicals, right? And also the job numbers and everything like that. But holding for the long term is a very, very different situation. Yeah.
Holding for the long term, I guess I'm so ingrained in the market. I'm an active investor and an active manager. So that's just my process. But I look at it as sort of making money in the trenches when you hedge. You be smart. You're actively management. You always hear, football commentators. How is this team going to win the game? Oh, it's going to be one in the trenches. It's going to be one in the offensive line or the defensive line. Hedging and having core positions, actively managing or rotating your portfolio. That's winning in the trenches.
All right. Well, Bill Baruch, we really appreciate your time today. Before we let you go, if our viewers would like to hear more of these interviews, they can go to libertyandfinance.com. Sign up for the free newsletter we have, or simply hit the subscribe button here on YouTube and the bell icon so you'll be notified of all the new interviews we're doing. And if people would like to find you, Bill, where can they find you?
BlueLineFutures.com. It's our futures and commodities site. We have our research up there. You can sign up for a free trial of our research. Goes out each day. I'm the lead author on the S&P, NASDAQ, crude oil, and gold. My partner, Philip Strebel, writes on about FX. He writes about the same stuff too, gold, silver. We also have our other partner covering agriculture. So we cover it all. And over the next month, we're going to be launching a new website with a ton of educational material, content, analytical material. So we're really excited about that. But right now, BlueLineFutures.com. Check us out. Sign up for our research there, and you put your information in. You get our research, and somebody can contact you, reach out, and we look forward to hearing from you.
Fantastic. Once again, Bill, thank you so much for your time today.
Thank you for having me.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin, satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us, Kaiser@milesfranklin.com.